I'm Matt Bishar with NAREITREIT.com. I'm here at the New York Hilton for REIT Week 2017, NAREIT's Investor Forum. Joining me today is Jim Connor, the Chairman and CEO of Duke Realty Corporation. Jim, thanks so much for joining us.
Well, happy to be here.
Now, last month, Duke announced that it would sell its medical office assets for $2.8 billion. Why was the timing right for this deal?
Well, we had built the business, the operating platform, and the portfolio to a size where we had enough critical mass that we thought we could get portfolio premium, and there were opportunities to sell the operating business and not just an asset sale. And so that's what we were ultimately able to structure with HTA, and the transaction is in the process of closing in various tranches, but they saw the value of not only the assets but the operating team to continue and grow the development business. So the timing is right from that perspective. And then, we looked at use of proceeds and were able to, we think, redeploy all the capital back into the development business acquisition, return some capital to the shareholders, and delever and improve the balance sheet. So, the opportunity to get great pricing, good use of the proceeds, and to become a pure play industrial company, we thought the timing was right, and we're very happy with the execution.
So picking up right there with the industrial sector, Duke's obviously well known as a developer and acquirer of assets. How do you see the balance between those two going forward?
Well, in the last several years, I would say probably 80% of the proceeds were put back into development and about 20%. So, on a gross dollar basis, that's probably, we were running about $700 million of development a year on the industrial side, and we were spending $150 million on acquisition. Still doing some deals, but being a little bit more selective, primarily trying to put that money back into high barrier tier 1 markets where we're trying to grow our exposure. Now with the proceeds from the MOB sale, I think you'll see us ramp up the acquisition side of the business to the point of where it's probably 50-50. But one of the things I preach to our people, and I've been telling the investors, is we've got to maintain discipline. We can't go out and spend money just to spend money. So we're continuing to focus on newer Class A buildings in those high barrier tier 1 markets. And if we can't find those, then we'll sit on the cash and it'll be a little bit diluted for a little bit longer. But we're not going to go out and invest in second, third tier cities or buy, functional to obsolete properties. We're going to, maintain that level of discipline that we always have and continue to, build a really quality portfolio.
Now, shifting to a trend that's impacted a lot of real estate sectors, sort of this ever-increasing speed that people want delivery. And when you look ahead at how that's affecting the industrial supply chain, what changes do you think are going to have to be made?
Well, you're seeing a couple of trends. We've been talking about for the last year or two about the last mile, and we do a lot of what we call infill development, which is really well suited for last mile. We're probably not well known for it because people think of us and they think of million-square-foot fulfillment centers, but the truth is we've done about 30 infill development projects in places like South Florida and Baltimore and New Jersey and Chicago and Southern California, and leased a lot of those buildings to people like Amazon and people like UPS and FedEx to really support the last mile distribution. The other aspect of it is what you're seeing with retailers and e-commerce companies is the speed to the ultimate consumer is getting much, much more important. And they're trying to wring every bit of cost out of that supply chain, and they're finding that putting those facilities, those fulfillment centers and those distribution centers closer into the population areas, even though the real estate is more expensive, is saving them much, much more money and giving them a competitive advantage for 2-hour delivery windows or overnight delivery. So instead of seeing a million-square-foot fulfillment center being built an hour outside of a metropolitan area, you're seeing it built in an established industrial area that's, in the core or on the fringe of the suburban area, giving them much closer access to the population base. So I think you're seeing a combination of both of those things.
Great. Jim, thank you so much for joining us.
Happy to be here. Thanks again.
For more from REIT Week 2017, be sure to visit REIT.com.